Hello everyone, in today's video, we will talk about a great and accurate way to find supply and demand zones, and apart from some trading terminology, which might confuse us. Before starting, we have to know that finding these areas should be on large frames, from 1 hour to 1 day or even more, and to get the best results, it is recommended to use it with a 4-hour frame. And to find out more, let's start with the rules and conditions. First, we want to see momentum candles in a previous area on the chart. In other words, we want to see that some candle has moved strongly in a short time, which sometimes called dumping or pumping. And this significant price change sometimes comes after the range movement, as we see here. Secondly, in the middle of this movement, we must see a price rebound resistance or a camouflage attempt from one of the trading institutions or one of the whales, which we can identify by seeing a green candle between these candles. The third condition, which is the most important condition, is to see that the red candle that follows the green candle is shorter than the green candle, in other words, that it did not exceed the price of the green candle. And once these conditions are met, this means that we have found the first supply area. And after we find this area, we define it by drawing a rectangle that borders the green candle from top to bottom. We take the rectangle tool from here and we cover the borders of the candle as you can see here. Now that we have defined the entry area, and since the candles are moving below it, this area will be the supply area, and since it is a supply area, this means that we will use it to enter short positions. But talk remains easy and implementation is the hardest, because with all that, there is still another problem. Because when measuring the length of this area, we find that it represents approximately 5%, which in itself is a profit and loss area. So, where should we set our sell orders? Should we set it here or here and here? Well, there are two ways to solve this problem. The first way is to look back for previous support or resistance levels that correspond to an extension of the supply area. As an example, this level and these two other levels represent a previous support area that can be used. And to find the support and resistance levels in an accurate way, you can use the RSI indicator, as we explained in previous videos. In short, and as we said earlier, when the RSI forms a bottom below the 30 line, we choose the candle that corresponds to this bottom, and we consider it as a support area. And since this support level corresponds to the supply zone on the other side, we will use it to confirm the entry area. We can also check previous support and resistance levels in order to increase confirmation. Well, the second way to accurately determine the entry point is to look for the nearest trend line. We can do this by drawing the previous trend lines, and if we find that one of these lines has passed through the supply zone, we use it to determine the entry point. Try to draw most of the trend lines close to the supply area, and when you find that one of them has passed through it, keep in mind that this line is the most important line. And to know that the trend line was drawn correctly, search the channel for the previous videos, because as we said, as long as the trend line passes above 3 tops or below 3 bottoms, this means that it is a correct line, and we can count on it and use it. Now that we know how to identify entry points within the supply and demand zone, let's see this in action. Well, these levels will be the levels for placing sell orders. The first level is the trend level, and the second level is the previous support level, which has now become a resistance level. Now, as you can see, the entry points were precisely touched by the candles, and then, the bearish reversal occurred immediately. And if we calculate the rebound that occurred from these levels, we find that it is close to 10%, and this is really something worth to think about. There is also another way to place limit orders, which is by dividing the supply or demand area into several levels, according to a specific capital management, but let us continue explaining the previous methods so that we can understand more. Well, let's take another example and say we were trading somewhere here. Here we see another price explosion, and we also see a range movement before it, so in this area, we have to think as well. The first condition is to see that there are several momentum candles that made a significant price change, and this is what we see here as temporary pumping. The second condition is to find a red candle in the middle of these momentum candles, which is this candle that we see here. The last condition is that the green candle that follows the red candle must be shorter than it, and its price has not fallen more than the red candle, and this means the opposite of the first example. And once these conditions are met, we will consider that we have found a demand area. We take the rectangle tool from here, then we cover the red candle from the top to the bottom, and when we are done, we have prepared our demand area. Now, let's run it and see what happens. As you can see, the price rebounded as soon as it touched the demand zone, and this means that the price action was good in this area. But with all this, we must find the safest place to set our entry order. Should we place our limit buy order here, or should we place it here? To find out, and as we said in the first example, we must look for the nearest support and resistance levels that pass through this area. But if we find that the support and resistance levels do not pass through it, we check the trend lines as well. In this example, we find that the uptrend line has passed from this area, and also the price has rebounded well from here. Also, we can try support and resistance lines, and if we find that they pass through this area, this means that we can use them, but if we find that they do not pass through it, we will ignore them. But now let me stop here at this area. Here we see almost the same conditions have been fulfilled, but if we look closer, we will see that the green candle that follows the red one has surpassed it in the lowest price, which means that there is a demand area, but it is weak, and it is not recommended to use it in placing limited orders. To find out more, let's run and see what happened. Here we see that it could not hold the candles, as there was no good retracement. But when drawing the area to review it, we find that there is a slight rebound, even in these weak areas, which did not fulfill all the conditions. And this means that supply and demand zones, even in the worst conditions, they may bring some profits. Well, let's take another example that is different from the previous ones. Well, here we see a strong pumping, but before it, there was no range movement, and the candles do not move horizontally as we can see. We also see that there are only 2 momentum candles, and there are no red candles between them. So we will ignore this area and look for others. Here also we may say that we can find a demand area because the price has changed rapidly. But look at the area before it, it was not moving in a range, rather, it was completely tortuous, and there was no horizontal movement. But with all this, let's say we can find a demand area here. First, all the candles here contain wicks of the same size as the candles themselves, and this means that they are not momentum candles, because momentum candles do not have much resistance, and wicks mean resistance. Well, let's look for another example of another kind of supply and demand zones. But not here, because here it is just pump and dump and does not contain supply and demand zones. But here it is different, here we see a range movement followed by momentum candles, but we also see a complete pause to this movement with several red candles. So where is the candle that we should choose to use as a demand area? Well, if there is a temporary stop for the candles, or they move at a similar level for a short period as we can see here, always choose the first red candle to be the chosen one. But the lowest price level for this candle must not be broken, and unfortunately this is what happens here. There is another candle that is retraced from the lowest price of the selected candle, and this is what made trading here swing trading, and it is considered a weak option to use as a demand zone. But with all this, it is still a demand zone, even if it is weak. So, let's say we want to look for an entry point here. First, we define the demand area, as we did previously. Secondly, we wait for the candles to move away from this area, even with one candle. And this red candle here has already moved away from this demand area, which made it an active area. Thirdly, we measure the length of this area, and because it does not exceed 1%, this means that the entry order will be at its beginning, and the stop loss will be just below it, or below the candles that broke the price. So, if we place a pending buy order, or a limit order, the entry order will be activated here, at this candle wick. As we can see, the price went up from the entry point, but we should not be greedy when the areas are weak, we take a small profit, and then we run. The last example in this video will be about this dumping here, and how we find the supply area in it easily. Well, here we see large and clear momentum candles, but we do not see any range movement before it, rather, all that was there is a large pumping, so, can we find a supply area here, after these candles? Of course, we can do that, as long as the price paused and then continued to fall. Because these temporary pauses, followed by a price drop or rise, as in the previous example, are the areas in which we will look for deceptive candles to place the supply or demand area. And to find out more, let's start with the conditions. First, we need to see red momentum candles, and in the middle of them is a green candle, which gives us the illusion that the price may rebound, and this is what we see here, but with several candles, that is, it differs from the first examples. Secondly, and because we have several candles here, we only check the first green candle, and if the candles that follow it are lower than it and did not exceed its highest price, it will be the target candle to draw the supply area. Thirdly, since the candles that follow our first green candle did not exceed its price and they are all shorter than it, this means that the conditions have been met and we can start placing the supply area. Well, let's go back a bit as if we were trading somewhere here. Now we cover the candle that we have identified as the supply zone. And once we see that the candles have moved away from this area, this means that the supply area has become an active area and we can use it to enter short positions. Now we see that the candles have returned to the supply area and it has bounced again. These retracements may continue for several times. As we see here, the candles have returned again and touched the area, then it went down. But as we said, if we want to place a pending or limited entry order, we cannot know that this will happen several times, except by using trend lines or support and resistance. But in the case of live trading, other indicators such as the RSI or MACD indicator should be used. Also, the use of some candlestick pattern is good to confirm entry points as well. Finally, is this the only way to find supply and demand areas? I was hoping for that, but there are dozens of other ways to find these areas, but I preferred to explain this method because of its simplicity and ease of conditions. And if you want to know more, do not hesitate to join our Telegram channel with a link below the video because you may find many things that interest you. Thanks for watching and don't forget to subscribe. Good luck.